September employment report will be coming our way at 8:30 a.m. Eastern Time. Join us now, Savita Subramanian, head of U.S. equity and quantitative strategy at BofA Securities. We usually have you here just to talk overall about equities, but there is a jobs number today. There are some different, I guess, angles to cover with the jobs report. What it does for the Fed, what that means to the stock market, what it does for the election. Are all these things things you're considering for what you tell your clients to do?
Well, today's report, not so much, because I feel like, we're 1 week doesn't make a trend, 1 month doesn't make a trend. But I think when you kind of look at the background right now, everything that we're hearing about is relatively inflationary. Wouldn't you think? When I look at what's going on with the Fed is cutting interest rates or has embarked on an interest rate cutting cycle. China's trying to stimulate their economy. The Fed is actually cutting as profits are accelerating, which almost never happens.
All-time highs in the market.
And all-time highs.
But the port strike was settled. That's not inflation.
The port strike was settled, but it was settled for higher wages. I think it's
exactly.
like 62% over the next 10 years or something along those lines. So we've got this big kind of, a wage increase in the works. I feel like this is an environment where maybe inflation isn't spiking back to 9%, but there's an argument that we see a little pickup in inflation over the next 12 to 24 months.
4 would be devastating if that happened on top of the 20.
You know what's so interesting, though? Think about where we are now, and I feel like it's anchoring because, back in 2017, if we thought that interest rates were going to be 5% and inflation was going to be 3-ish, we would have thought the market would be a heck of a lot lower than it is today. So I think that what we're seeing is just corporates adapting to, at different rates, a different inflation environment. I've said this, and some people think I'm crazy, but I think that, real rates of 1.5% to 2% would be okay for the economy. We've seen this before. We've seen it in the 80s and the 90s. Folks think that rates are unsustainably high right now and they're going to choke off the economy. But when you think about where rates are today, and nominal rates and real rates, they're actually at kind of low-ish levels relative to history.
If we did have a 4% print over the next year for inflation, do you think that'd be okay?
I think it would be okay for certain parts of the market.
Well, you said corporations. For people buying eggs or whatever it is they're buying, I don't think that's going to feel good.
It's not going to feel good for the consumer, and I think the lower income consumer and lower to mid income consumers are already chafing at prices. But when you look at corporate profits, what's shocking to me is that we went through a period of 9% CPI and corporate profits barely compressed. It was like a couple of basis points in most sectors.
If they are gouging, they should have widened.
Well, I don't think they were gouging, though. I think it was just an environment where they were figuring out ways to cut costs.
So they raised prices,
spending,
but not enough to cover their costs.
Well, I think that it was an environment where they did a bunch of everything, as corporates do, to rejigger their business
margins
model.
compressed.
Margins compressed a tiny bit, and for certain sectors that were more labor intensive. But I think what was shocking is how little they compressed during that environment. So I guess what I'm saying is I think we're in an environment where corporates are adapting to this new normal of higher for longer rates and inflation versus what we were in, in the 2010s.
Well, back to the 4%, and I'm not saying it will be that, or even 3. Who knows? Just pick a number higher than 2.
Right.
Does the Fed go another 120 basis points, 150 basis points down?
I think that the Fed has, I'm not a Fed expert and I leave that up to our economists, but I think that they've been signaling to us that they're buying themselves latitude to change their mantra. This whole time they've been data dependent, driven by the data. We've, at the beginning of the year, we thought there were going to be a lot more cuts than what we're actually seeing. The market has survived. So, again, I think the Fed is important, but not necessarily the ultimate arbiter. I think what's important, if you step back and you look at what's going on right now in corporate America, We've got reshoring. We've got this manufacturing pickup in certain parts of the U.S. economy that haven't been busy for a really long time. We've got nominal GDP growth surprising to the upside. I mean, I hate to say this word because I know that equity strategists are always accused of being Pollyanna-ish, and I've been bearish before. But I feel like this is Goldilocks. This might be Goldilocks. We've got the U.S. is actually in a pretty good position. I mean,
you feel scared saying that?
I do. I feel like I'm going to be struck down by lightning. Right. But I think that there is an argument to be made that cyclicals are going to do okay, that consumers are going to continue to spend, maybe not as much as they did when inflation was zero. And, you know, the world goes on, and nominal GDP trends higher.
Getting resolved so quickly. Again, we don't know what happens come January, but getting that resolved quickly before it really causes massive problems. You still have the Middle East.
Right.
But you've also got China that's doing all kinds of stimulus.
China's stimulating. The two biggest economies in the world are in stimulus mode. Yeah. I think that's positive and potentially inflationary. You know, is the market multiple justified? I think in parts it's too high. But think about it. I mean, we've got areas of the economy in manufacturing that have been underinvested in for a decade or more, and now they're coming back online. And granted, there's supply chain issues and strikes and, you know, the typical friction. But I think that what we're seeing right now is sort of a shift from just spending on tech and asset-light business models all the time to a more normal CapEx cycle, a more normal economy, a little bit higher rates, a little bit higher inflation. Goldilocks. Wow. I'm going to say it again.
No, higher inflation won't be Goldilocks for most people. It's got to, and the Fed is set in stone at 2. They can't back off that because they're already getting criticized about, you know, about shifting to labor when the job's not done with inflation. And if there's any spike back up, they're going to be. I just think they're very paranoid about that.
Yeah, I mean, I think the Fed might pause. You know, I mean, who knows? They could even hike again. Oh no,
another pause that we'll be waiting for. We just finished with the last pause, but that was going up.
That was, yes, I know. It's interesting. I mean, I think the Fed is, I mean, obviously critically important, but I think what's also important is the fact that corporate America has navigated this environment of massive volatility in rates and inflation, and earnings have remained relatively stable.